Let's suppose we have 4 projects, or security returns, if you will, and we have A in the upper left, which has a high return, but a relatively low volatility. B has likewise a high return, but a high volatility. C in the lower left has a low return and a low volatility. And D has also a low return, but a high volatility. Notice I let it go negative there. Yes, of course you can get a negative return with high volatility. Let's transfer these returns for these 4 projects to a 2-dimensional graph where we have return on the vertical axis and the volatility or risk, often measured in standard deviation, on the horizontal. And sure enough, they line up with A, B, C, and D in their respective places. Now at this point, let's ask which of these would you prefer? And it turns out there's not necessarily a correct answer, but as we will see, that tends to narrow down to just 2 choices. Everybody loves A. Well, you prefer A over B, certainly, and that's because we prefer to avoid risk because losing hurts more than gains. On the other hand, some of us might like C because it's low in risk, but gee, it has a low return. And I don't think anybody would like D, which has high risk and a low return. Well, guess what happens? A is so desired its price rises, making its subsequent return lower. And D is avoided because, well, everybody shuns it. Its price drops, raising its return. So what do we have left over? Well, we have left over B and C. And there's really no correct answer here. Some people like the safety of a low return, and some people like the risk associated with a high return. And that's where the matter remained for a while until Markowitz looked at it and noted, as many others did, that the negative correlations, if they're available, would certainly be able to dampen the risk to a portfolio. And even a random security could dampen it a bit. There are some negatively correlated security returns, such as, say, airlines and oil stocks. The airlines don't like it when the oil prices rise and vice versa. Suppose we were to combine those 2 together. That produces the upper right panel, and they dampen each other significantly. Of course, they're not always available as such, being highly negatively correlated. You might have a randomly distributed security return, and you might combine it with one of these or any others, and it certainly would dampen it somewhat. Well, Markowitz said, let's look at the mathematics of that. And he looked at the correlation coefficients. I'll spare you the math here, but correlation coefficients can range between -1, perfectly negatively correlated, and perfectly positively correlated, a +1. And a random portfolio would have lower risk, 0 correlation, but notice it doesn't go to 0 because there's still some volatility remaining. Well, some other folks looked at that and said, what if we had more than 2 securities? And of course they'd be scattered all over the place. And let's see what happens if we combine them together. And here we really don't need the math at all. Recalling that in this risk-return 2-dimensional space, that the combinations always bend to the left or are a straight line. So if we took a whole bunch of securities and laid them out again in this risk-return space, we would see, well, maybe we could create a feasible set. Now notice if we combine each and every one of these together, I won't clutter up the graph here, that it's either going to be a straight line or bending to the left. And if we, let's say we look on the right-hand side, the blue dot to the orange dot might have 0 correlation, bend a little to the left. The orange to the green might be perfectly correlated, have a straight line. The green to the yellow might again be zero correlation, bending to the left. And maybe the yellow to the blue may be perfectly correlated. And we do this again and again and again. And it turns out the grand edge of all of these will smoothly bend to the left. So what remains is the feasible set. And where do we want to be on it? Well, we'd like to be high on the return, low on the risk, and notice that that right side actually is not too relevant anymore. We would certainly like to be on the uppermost piece of the feasible set, and our choices there is individually different, but then it turns out there's more. And that's because we've only looked at risky assets so far. Turns out there's maybe a risk-free asset. In the United States, that might be treasury bills. They have a certain return because you always get back exactly what you want, and has a zero standard deviation as well as a zero correlation. But it turns out if you have a zero standard deviation, that's a linear combination that always creates a straight line. Well, if we have a straight line, it would start with, well, the risk-free, having a return that's probably below most of them, safer, and it has a zero risk. Now that straight line will combine with any of the portions available in the feasible set, but remember, we want to be on the uppermost portion. And because we showed that that was smooth and continuous for the feasible set, it would have a tangency, here labeled M. I'll explain why later. And up to that point of tangency M, you could buy in various proportions. And you could go beyond M by buying on margin. We're going to call this line the capital market line, the CML. Now let's overlay this with a set of individual choices, say for this particular person, where the pink area is where they're the happiest, orange the next, the kind of light green, less happy, and so on, where they really hate a lot of risk and low return, but they do like in the pink region where they get a lot of return and low risk. For this person, they probably would like something on the far left side, high as you can go, and had they been on the feasible set, they could improve it by moving up to the capital market line using various proportions of the risk-free and the market. Of course, that's not always true for all people. We got to have a person with a different set of utility risk-return preferences. And again, they'd like to go up and to the left, but they have a tangency that's a little more risk-tolerant, higher return, higher risk. But again, they will move up to the capital market line, and in their case, perhaps using margin, borrowing, if you will. You may have noticed that I referred to that tangency between the CML and the feasible set as the market. That's why we called it M. And there's something called the separation theorem, meaning that what you invest in and how you invest in it are really separable. Your choices now rationally on the capital market line are only the risk-free and the market. Everything else is less preferable. Now, I like to make the silly analogy. It's like having chocolate chip cookies. There's only two components in the chocolate chip cookie recipe, cookies and chocolate. Now, you may have a preference for more chocolate, no chocolate, lots of chocolate, a little chocolate, but notice that's separated from your preference as to what the recipe components are. Well, it turns out we can go back to a risk-return space, but the risk is now measured in something called beta. I'll spare you the math, but formally it's the covariance divided by the variance, in this case, that of the market. Now, we're presuming that tangency point that we looked at before is the market because notice everybody used it. It was separated from their preferences. Now, look at this. we have, well, let's see, the risk-free is probably going to be low because it's low in risk and it would have zero beta, zero correlation. Now, turns out the beta to the market, the beta being the relationship covariance divided by the variance, and it mathematically turns out to be 1, meaning the relationship of the market to the market is, of course, 1. Well, look at that graph. That straight line we're going to now call the security market line. And it brings up the equation of what we call the capital asset pricing model, the CAPM, the CAPM. Well, let's see. Any equation has an intercept. That's the risk-free. It has a slope. Now, the slope is what? The run divided into the rise. And the run here for the market of a beta of 1 is 1. And what should you get if you are investing at the risk of the market? Well, you should get the risk of the market. That's RM here. But the slope is the amount above the risk-free. We call it the market premium, RM minus RF. And, well, what's the run? 1, trivially divided into it. You get the market premium is the slope, RM minus RF. And there's our equation. Any particular return to security I should be the risk-free plus its individual beta times the market premium. Well, notice there are different betas for different securities. Grocery stores might have a beta of 0.5. They go up and down half as much as the market. You might have a beta of 2, highly leveraged or, say, capital goods firms. You could have a negative beta, say, pawn shops where they go the opposite direction, or repair shops, opposite direction from the market. You could also have maybe a beta of 0. Dairy farms come to mind. Work with me here, because I think those cows will provide the same amount of milk regardless. And so you plug in the beta, and that's the return you should get. Here, let's do an example. And yes, finally, the math does arrive. We got a graph over here. We got 3 projects or securities. And, notice the blue numbers are for the return to the market of 12, and the risk-free is 4. We have Project A has a beta of 0.5, but makes an actual return of 9%. B has a beta of 1.5, but an actual return of 18. And C has a beta of 2, and an actual return of 19. And boy, C sure does look tempting, but watch it. So we plug into our equation, and for A, well, let's see, we got 9, but we should have gotten only 8. We'd accept that. And again, that's 4 plus 1/2 of the market premium, which is 12 minus the 4 is 8. Half of 8 is 4. 4 plus 4 is 8. But 9 is better than 8. We accept it. Let's look at B. Beta's 1.5. Premium's 8. So that's 12, 4, 16. But 18 is better. We accept. But C has a beta of 2. Well, that's the 8 is 16 is 4 is 20, but we only got 19. We reject it. Let's go back to our original graph and capital asset pricing model equation. Again, it's the risk-free plus the individual beta times the market premium. This green area here, notice it's below the market. Gee, it's not doing that well, but we still prefer it because it's above the security market line. We call those cash cows. So my analogy to that dairy wasn't so superfluous after all, was it? With Dr. C Invests.